Well, hello everyone. This particular episode is probably going to break the 30-minute target that I have, specifically because I have about 20 minutes worth of visual aids to help explain a 1031 exchange and what you might want to know about it. It is not intended to be all-inclusive by any means, and I am not a tax attorney, tax consultant, enrolled agent. I'm not a title guy. You're getting the idea. This is for entertainment, but I think it's going to help you understand some stuff. Even if you are a person looking at investing, or you're specifically new in real estate and you've attended a couple 3-hour classes and you think you got a good grasp on it, maybe you do, maybe you don't. But one of the first things that I want to address is at my first class, professionally put on class, regulated and approved by the state of Tennessee's Real Estate Commission, I heard some things like, I don't think that's what the law says. And when I looked it up, I felt like either I must have misunderstood them, what the statement was, or there was an error in there. And that was from people holding themselves out as that's what they do. Now, what I want to get to is this. The difference between capital gains and income, business income, a lot of it has to do with the time frame that's involved. Capital gains are usually long term. There are some short-term capital gains in the nature that they are gains under the tax code, but they're not 1031 qualified capital gains in this exchange. And there are also a couple of other exchanges. And if I open the law up, I may show you that. I may show you a couple others just so you understand that this is just one narrow piece of law of the tax law. It's not real estate law, it's tax law, and that's what we're dealing with. For instance, there are other laws when we get involved with in real estate. And the first one I want to talk about flips. Have you ever seen late at night when you're having insomnia, someone on TV saying, come down to the Ramada Inn and I'll give you my free book about my system? And what a lot of times you might find out is what they are is that person is willing to let you use their money for a percentage of your profit, but they're only taking the financial risk legally for doing so, and they're letting people, average folks, try to go out there and compete and buy a house with the intent of keeping their eye on the ARV or the after repair value. We're going to repair it, we're going to get it fixed, and we're going to sell it for a huge bunch of money. But here's the rub a lot of people don't get told when they're doing that. You have the rights to repair and work on your own house to a certain extent. And that's because you're doing maintenance to your house. If you're involved with the remodeling of a property for the purpose of resale, that work normally will fall under a contractor's license. Do you have a contractor's license? Do you know about it? Are you a real estate person and you think you're going to get in here and make millions of dollars off of a crack pipe or something in there and just do the water line repair and call yourself good and go? The problem with some of that is you need to make sure if you're doing something like that, you have a professional do your work, because you're exposed right off the bat, because anything you discover after you've bought that house, whether it was known to you before or not, doesn't really matter. You know about it, it has to go in on the disclosures. If you know about it, you have to disclose it. So if you find out you have a cracked foundation, too bad, so sad, you have to tell them that the foundation's cracked, or you have to fix it or whatever. It has to be addressed. You can't claim ignorance because you're trying to make some retirement money. The law doesn't care. Your buyer certainly doesn't care. No one cares. Maybe you do, but it's not copacetic. You have to follow the laws and rules, and there's a reason we do that. So I will always tell people, get a professional to do your repair work for you, and then you can say, I don't know about that. Here's the name of my contract to go talk to them. So we're already off on a good start there. So what a lot of people don't understand, I've actually heard other people in business say, well, if you buy the house, and you make a bunch of money, you can roll it in as a capital gains. You can't do that because it's not a capital gains. If you buy a house for a repair, fix up, and a resale in short term, that's a flip. And that is excluded from the 1031 exchange. Now, I also want to point out that the government doesn't care. The government wants its money. And the government, the way laws work, is we have a couple things. You have to have a statute that authorizes the rule or the Code of Federal Regulations. So you have to have the USC give the authority to the CFR, and the CFRs are generally done by the administrative branch, who are set out and tasked with enforcing the laws that the legislature put in place. Now, you'll notice in the history of the Starker Exchange a couple of things. We start out with income tax law, legislative act, and then we get into a couple of changes, and then we start to get, in the later years, we start to get more into, well, we'll handle that by rule, we'll change the rule, which will change the overall effect of the law. And then we start getting into interpretations put out by the department who's doing it, saying, well, this is what we think it means. And then eventually they'll pass a law and fix it back and correct it. And in 2017, we had a law change in between the legislative act of putting in the income tax, or when the income tax I reference is right after World War I, to the current last change in 2017. You'll notice some changes and things that went on, how they handled that. And a 1031 exchange is not the only type of capital gains exchange or deferral that we have. And if I open the law up, we'll look at that, and I'll point out a couple more you probably didn't know were there, because guess what? You're not a tax person. I'm guessing you're probably not a tax person. I certainly am not. So what do you say we roll that video and pay attention to the sequence of events? At the turn of the 20th century, there was a war on, and the country needed money. World War I, to be exact. So in 1918, Congress adopted the first income tax code, and the Revenue Act was law. Government can't just leave laws alone, so in 1921, Section 202C was created to provide relief to tax-paying Americans through a deferral incentive. The goal was for people to reinvest today's taxes, and then with good fortune, the government would net more money in the future. And by money, they meant tax revenue. Section 202C allowed for both like-kind and non-like-kind exchanges. You can't just sing the same old song forever, so in 1954, the tax code changed Section 112B1 to Section 1031. But in 1979, things changed when T.J. Starker exchanged some timber property to Crown Zellerbach Corp. Under agreement, the company would exchange like-kind property over a 5-year period to T.J. Starker. The IRS denied the tax deferral, arguing that a 1031 exchange required a simultaneous swap. They lost in the Ninth Circuit. Starker versus United States 602 F.2D 1341. The federal tax code did not require a simultaneous transaction, so in 1984 Congress revised the law and proposed a 45 calendar day identification deadline and a 180-day exchange period. The Tax Reform Act of 1986 and the Revenue Reconciliation Act of 1989 changed some laws. The Treasury Department proposed rule and regulation changes in 1990. In 2000, 2002, 2004, the IRS issued new rulings and procedures. And finally, the Tax Cuts and Jobs Act of 2017 limited a 1031 exchange to real property only. Although U.S. history and tax law are largely considered to be common knowledge, the Internet was consulted for some data. Sources are cited. As we can see from that video, we had some tax law go in, and I've had some people tell me, well, you know, we were drawing some form of income tax as early as the Civil War to pay for Reconstruction, and I don't know the subtleties between that and the Revenue Act that we had in 1812 after World War I, because it doesn't really matter to me. I don't live before 1918, and so I have to deal with my reality today and how that affects it. But you're welcome to check and see how things are going for you. Matter of fact, I challenge you. Take everything you have seen and will see with a grain of salt and go look it up for yourself. Because again, what did I tell you I do? I call to professionals who do the actual exchange and file the actual exchange paperwork. And it's only, I think, 2 pages. So it's not that big of a deal if you know what you're looking for and you're a tax guy and that's what you do. And a lot of times you might use the title guy, someone who handles that specifically on a regular basis. I ran my videos past an expert, and let him look at it. I said, do you see anything where I've really gone off the deep end of the boat on this? And he said, no, they look good. And all I'm trying to do is explain to you, get rid of kind of those misconceptions of what a 1031 exchange is. It's not the Holy Grail. It isn't. And you'll hear a lot of people who want to get your business will tell you, oh, yeah, we can save all that capital gains. But at some point, you're going to have to get that money out, right? And you're going to pay taxes on it. So who knows what the future is? One thing that they never tell you is that by the time you get to retirement or whatever, you want to cash all those capital gains out, the actual rate may be higher. It may be higher than if you paid it as income today. So we don't really know. It depends on politics, and politics drives the government. Government drives the economy. Economy drives personal economies all the way down to the household level. So if you get someone in, say, 20 years from now who changes the law again, as you've seen that track of law changing and rule change and interpretation with their position papers or their instructions, you find out that you may end up paying more taxes in the future on capital gains than you would have if you had to pay them as income. It depends. There's usually a percentage in there that has been holding true for the past several decades. So at some point in your life, you may not want to capture all of that capital gains. And that's something that you might learn from watching my video. It depends on your tax strategy. And guess who handles that? Not Dell, your tax man. So they will help you in that regard. I just want you to understand really well what a capital gains is as it applies to a 1031 after 2017. So we saw we had some changes there, and they went through the years and they changed this and they changed that, and the rules and all that changed. So I don't do taxes. Have we settled that? Well, I don't do the taxes, but I understand a little bit of it, and I can help you maybe with your exchange with a little deeper understanding other people do. So what do you say we look at our next video where I explain, just to make sure you know, just to show you the difference between evasion and avoidance. And it also gets into the fact that you saw the government denied Mr. Starker. Mr. Starker said, the law doesn't say it has to be simultaneous. Oh, yeah, it does. It's got to be. That's the way we do it. It's always got to be simultaneous. But what does the law say? The law didn't say it had to be simultaneous. Just because that's the way we've been doing it doesn't mean that's what you're limited to or whatever. It just means the taxing authority, the IRS, that's the way they interpreted it. It's not what the law said. Starker sued them and Starker won. And then it was some years gapped in between there before they actually changed the law to support that. They allowed it, and then they set some time limits and stuff, and that came out of the other. Because, again, it went from, it has to be, in our opinion, Mr. Government, it has to be simultaneous to, oh, no, it doesn't, to, well, maybe we need to actually put some time limits on that, and they had a legislative act, and they did that. And it was a little bit after that. You can go back and review that film. That's the important part. That's the big part I was going to get to, and to show you that the government kind of does what the government wants to do, which is something I'm going to show you in this next video. Evasion versus avoidance. What is the difference between tax evasion and tax avoidance? Tax evasion is a crime. Tax avoidance is a right. Tax evasion is the illegal evasion of taxes by individuals, corporations, and trusts. Tax evasion often entails taxpayers deliberately misrepresenting the true state of their affairs to the authorities to reduce their tax liabilities, and includes dishonest reporting, such as declaring less income, profit, or gains than the amounts actually earned, or overstating deductions. Tax avoidance is the legal usage of the tax regime in a single territory to one's own advantage to reduce the amount of tax that is payable by means that are within the law. Tax sheltering is very similar. Tax havens are jurisdictions which facilitate reduced taxes. Did you know? World-famous racketeer Al Capone was sentenced to 11 years in prison for tax evasion and fined $80,000 on October 17, 1931. Did you know that there is at least one United States Supreme Court opinion that discusses the difference between tax evasion and tax avoidance? Would you like to know what the justice said? The United States Petitioner v. Thompson Center Arms Company 91-0164 4, 504 U.S. 505, 1992. Justice Souter announced the judgment for the court. Note 4. We do not accept the government's suggestion, however, that a complete part kit must be taxable because otherwise manufacturers will be able to avoid the tax. Brief for the United States 11. Rather, we conclude that such kits are within the definition of the taxable item. Failure to pay the tax on such a kit thus would amount to evasion, not avoidance. In our system, avoidance of a tax by remaining outside the ambit of the law that imposes it is every person's right. Over and over again, the courts have said that there is nothing sinister in so arranging one's affairs as to keep the taxes as low as possible. Everybody does so, rich or poor, and all do right, for nobody owes any public duty to pay more than the law demands. Taxes are enforced exactions, not voluntary contributions. To demand more in the name of morals is a mere cant. 1031 exchange, a simple definition. Specific to real estate, a 1031 exchange is a swap of one or more investment properties for one or more replacement properties of like kind in adherence to strict IRS criteria, which allows capital gains taxes to be deferred. Well, be honest, how often do you see Al Capone and Thompson Center brought up in a real estate related video, entertainment video? But since it's entertainment, I can do that. Now, it's important to note that both in Thompson Center's case and Al Capone's case, they didn't go after him with a criminal act. They went after him with tax law. They didn't go after him with Title 18, which is criminal acts. They went after him with Title 26, Revenue Act. They went after him with an easier and lower duty to convict was on a civil case versus a criminal case. You have, the standards are different, and a lawyer can explain that to you. But they were basically, in the case of Thompson Center, the Supreme Court explained to them later in that opinion that you're trying to make a criminal conviction out of a civil problem, tax. And they said, you're not going to do that. That's why it's very important that we stick to our constitutional authority that limits power and what people can and cannot do, else they just steamrolled over them. In the case of Starker, they denied his tax benefit. He followed the law, apparently, as history dictates to us. He followed the law, and they said, no, we're not going to allow you that deduction, that expense, that rolling of it over. And he took them to court and won. Thompson Center took them to court and won. You can win against the government. You can fight City Hall and win, but it's going to probably cost, and it's going to take time and effort and all of that. So, just because someone files an action doesn't mean they're in the right, and just because someone who denies you something doesn't mean they're right, and if they allow you to do something doesn't necessarily mean that you're in the right when they do. So it's just one of those things. Now, the next video is going to be on, what was I going to do that on? The equity and negative equity. It's just kind of some definition. Let's roll that real quick. It's pretty short. I think it's only a minute or two. Let's get that done. Equity, negative equity, capital gains taxes. Question: what is equity, negative equity, capital gain, and capital gain tax? Equity, as it applies to real estate, is the value of the mortgage property after deduction of charges against it. Negative equity, as it applies to real estate, occurs when the value of real property falls below the outstanding secured debt against it. Capital gain, as it applies to real estate, is an increase in the property's value. It is said to be realized when you sell the property. Capital gains tax, as it applies to real estate, is a compulsory contribution of a percentage of the positive difference between the sales price of a property and its original purchase price levied by the government on the seller. selling price minus closing expenses minus outstanding debt equals equity, and it can be negative. Selling price minus purchase price plus capital improvements minus depreciation equals capital gain. To avoid paying capital gains taxes, move all of the equity from the relinquished property to the acquired property and retire no debt in the exchange. Ensure that no capital gains are realized. Now that was just some definitions of what equity and the various bits are. They're pretty straightforward. I guess the next thing we need to talk about is relative to the exchange itself. Now the exchange, to understand that, you have to understand a little bit of that Starker history, which I will refer to right now. You remember Starker? At the point in time, as the tax law evolved, they had the incentive that they wanted you to reinvest that money in hopes that your efficiency in reinvesting would lead to more taxes in the future. The government is betting on you paying more in the future than you would pay if you paid now. So that's kind of what they're doing. Now, when Starker did his exchange, up to that point, apparently everybody was just doing it as kind of even swap season in the middle of a particular tax year, and that was it. But Starker said, well, knew that the law didn't say what the law didn't say, and so he took it on face value that as long as he didn't realize that capital gain, that he did not take the money, that he did not possess the profits or whatever coming off of it, it wasn't then a capital gain, that it was in fact not realized. So what he did is he did the exchange on some timber property with a company, Crown Zellerbach, if I remember the company right. And instead, because they were both in the timber type of business, and he sold the property to Crown. Crown then took it, and rather than giving him money, his profit for his portion, he said, no, why don't you hold my money on credit with you? So we still got the bookkeeping to balance. It's just I won't take the money. You'll hold the money. And then when I find the replacement property, we'll do the swap at that point. We'll finish out. And the government said, no, we don't like that. You need to do it this year. We need to get it cleared this year. And he said, no, I don't think that's what the law says. They went to court. Starker won. Now, we also saw in the other video how they went after Al Capone, not on criminal. They went on him after taxes. And we see that the same thing happened with Thompson Center. They didn't want him to do what they were doing, so they went after him with trying to be a tax avoider, and that didn't work out either. They lost there. So you can be sued regardless of, you can have an action brought by someone against you, whether you're guilty or not. That's just the issue. How much is it worth? What is the time and effort and all that worth to you? So we've got that. So you need to understand, in an exchange, after the Starker, they lost, they went ahead and let people do the non-immediate or delayed exchange. But in the 80s, that was in the 70s, in the 80s they came back and they passed a legal update, a statutory update that said, no, we have some timing that you have to do. You have some periods. You have two periods, 45 days and 180 days. And the thing about those is the government's trying to clamp down. We're trying to make it a little bit more difficult to get this tax deferral from you because we want our money. We want the money. Show me the money. They want the money. And so they kind of try to make it a little tighter. Then in 2017 in the Jobs Act, they went further by saying some of the stuff that would go into a legal exchange, that would have been, of course, gone through all the attorneys and all the people to know it. So when they do that, they would be able to take some other things. And this has changed since 2017, that they now say it must be like kind. The problem is exactly what like kind is. The law says one thing, and the government kind of hints at something a little more harder to qualify if we look at that. Let's just go ahead and roll that particular film. Like kind exchange. Question: what is like kind in an IRS Section 1031 exchange? Like kind exchanges. Generally, if you exchange a business or investment real property solely for business or investment real property of a like kind, Section 1031 provides that no gain or loss is recognized. Question: is purchasing distressed real property for repair, remodel, or renewal qualified for a 1031 exchange. Section 1031 does not apply to exchanges of real property held primarily for sale. 26 U.S.C. 1031A2. While short-term capital gains may exist, the intended use is inventory for resale and the property is not held for business income or held for investment appreciation as required by Section 1031. In the IRS webpage, Like-Kind Exchanges, Real Estate Tax Tips further elucidates like-kind by saying, quote, properties are of like kind if they're of the same nature or character, even if they differ in grade or quality, end of quote. And then proceed to state an apartment building would generally be a like kind to another apartment building. The law says, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind which is to be held either for productive use in trade or business or for investment. The IRS webpage, Like-Kind Exchanges, Real Estate Tax Tips, also states, however, real property in the United States is not like-kind to real property outside the United States. Question: why can't other tangible items of value such as heavy construction equipment, agricultural equipment, or intangible items such as brand recognition and goodwill be included in an exchange? As of 1/1/18, the effective date of the relevant parts of the Tax Cuts and Jobs Act of 2017, Section 1031 of the Revenue Code now excludes most of it. There are a few special provisions remaining, and a 1031 tax specialist should be consulted to address those specific concerns. Now, I'm not an expert, don't claim to be one. I just need to know when it's time to call the experts in. The experts seem to tell me that like-kind is fairly broad, as long as it's used for income or productive use. Well, did you notice at the end of that video that the silhouette guy with the question mark scratching his head, did you notice he had a beard? Okay, so like-kind, anytime you're dealing with laws, especially tax laws, it gets kind of tense, nerve-wracking type thing. And the IRS doesn't really help much, because if you look at their tax tips, they talk about, well, if you exchange an apartment for another apartment building, that's a like kind. Even if there are different qualities, maybe you go from luxury apartments to shelter, or shelter to luxury type apartments. You know, apartment to apartment, we pretty well much figure that's like kind. Even I can figure that much out. I think that's a pretty safe bet. But the question is, say, if you hear an apartment, you hear words, rumors, things going on, that we're going to have a huge influx of large apartments and you have a bunch of rentals, you might want to change those. You might want to divest at that point in time and sell those rentals out and get something else. Well, common sense would kind of think, well, if an apartment for an apartment is like kind, then I can probably swap out an apartment for rental units for an apartment, or rental units for a quadplex, or maybe 2-3 quadplexes for a 12 unit or more, whatever we're doing. We could see that because we kind of get it in. It's kind of implying in your mind that the occupancy has a lot to do with it. The law doesn't say the occupancy affects like kind. What the law refers to is income and usage, and they call it productive use. So if you hold something for investment, like you're buying land and speculating on it, you can change that for other land you have speculated on and swap it out. If you have something that's doing a productive use of generating income, such as a rental unit or apartment or whatever, the experts tell me that if it's generating income, I can sell that residential property and exchange it for commercial property, like say a little strip mall or something that has rental, business rental income to it. It's still productive use. That's also like kind. It's just when you read the tip on the IRS page, they just tell you not really all that helpful. So it would kind of almost suggest that some of these exchanges would be more difficult to do. And it's almost like they really doesn't, their heart's not in it to see you do a deferral. Now here's the thing. If we go back to the beginning, the concept of letting you invest your money, they consider it their money. That's their taxes. The king wants his shilling. It's his money. He's just going to let you keep it if you'll promise to reinvest it where he gets more money in the future. He's betting on that he'll get more tax revenue in the future, and you're betting you can work a tax strategy so you'll pay less in the future, and you might. So a lot of these 1031s talk about how to capture all of that deferral, when in fact, at your stage of your business, your business development, maybe you don't want to capture it all. Maybe you need to want to pick a time that you start realizing some of those capital gains, and that can be a strategy that I might be a part of, helping you with your property. You might actually realize a little capital gains in maybe a down year. It's going to be some taxes you wouldn't pay normally, but is a point of, do you pay it now? Do you pay it later? That's why I defer to tax advisors and closing attorneys and people who do this. I need to understand well enough to help you find your property, and I'll do that. But I'll leave the expert advice to the experts. But you see how complicated this gets real quick. And you're not going to learn it all on a 3-hour class at some lunch and learn, and you're not going to learn it necessarily off of me, but maybe I can augment some of your understanding. So what do you say we look at those time frames that were put into place in the 1980s, where we had the 45 days and the 180 days? Because the thing I want to drive home, it has to be income realized. That's what we're trying to avoid, is realizing income. And the other thing, we want to get it all done in a tax year, in a single tax year. And that's why we have 45 days for identification, 180 for the total, or to the end of the tax year, whichever comes first. Now you can get an extension, and your tax year will be advanced a little bit if you need to pick up those 180, the rest of those 180 days, but it can never be more than 180 days in your exchange. They fix that for you, and that kind of makes it a little harder to pull some of this stuff off in. So what do you say we go look at that last film, the 1031 exchange? Question: what is an IRS Section 1031 exchange? 1031 exchange, a simple definition. Specific to real estate, a 1031 exchange is a swap of one or more investment properties for one or more replacement properties of like kind in adherence to strict IRS criteria, which allow capital gains taxes to be deferred. Simultaneous exchange. Quite possibly the easiest exchange to conceptualize is the simultaneous exchange. Simply put, the relinquished and replacement properties close on the same business day. If there are any issues that result in delay of one, the other must likewise be delayed, because if they don't close simultaneously, capital gains may be unintentionally realized. Delayed exchange. The delayed exchange is the most common. In it, the relinquished property is sold before the replacement property is purchased. Because the exchangor cannot receive the proceeds from the sale, he must use a qualified intermediary to initiate the sale and receive the proceeds. From the time of closure on the relinquished property, the exchangor has 45 days to identify in writing the replacement property and 180 days to complete the replacement. Improvement Construction Exchange. In the Improvement Construction Exchange, the exchange happens in the same sequence as the delayed exchange, with the notable exception that the improvement construction of the replacement property can be paid by the qualified intermediary with the equity from the relinquished property. All remaining equity must go into the replacement property, and ownership transfer before the 180 days expires. Also, the property must be substantially the same property that was identified in the identification period. And finally, the replacement property cannot have less value than before the improvements. Reverse, forward, hot market exchange. The last exchange is called a reverse exchange or forward exchange, in what I nicknamed a hot market exchange. When the process is explained, each of these names will make sense. The common sequence has the liquidation of the property to be relinquished in an exchange first, followed by the direct reinvestment of the proceeds from sale into the replacement property. Capital gains are said to be realized when they are received. In strict adherence to IRS Section 1031, a facilitator or qualified intermediary receives the proceeds from the sale, which include capital gains, on behalf of the exchanger, and as a result, the exchanger never realizes the capital gain. There are other terms and conditions. However, in a delayed exchange, it is sell first, buy second. The events in a reverse, forward, or hot market exchange are reversed, where the replacement event is brought forward in time prior to selling the property to be relinquished. In a starker or delayed exchange, there are strict time constraints. While there are rules to be discussed later that ease timing issues a bit, this sequence can be a challenge in hot markets. In a hot or seller's market, finding suitable like-kind replacement properties may be more difficult, and liquidation of a currently held property relatively more easy. To avoid capital gains, the replacement property must be able to absorb all of the equity without retiring any debt when the relinquished property is sold. A confounding issue is the exchanger cannot complete the replacement prior to sale of the relinquished property. This is accomplished by fully funding the purchase of the replacement property forward in time and having an exchange accommodation title holder, EAT, park the title. Generally, to obtain financing, the investor must be able to cede position on the title, which the exchanger cannot receive prior to closing on the sale of the relinquished property in an open exchange. As a result, a forward exchange is typically a cash deal. Cash deals like hot markets, and hot markets drive inventory lower. This type of exchange can be thought of doing the hard part first, finding and securing suitable like-kind replacement property of equal or greater value. Having confidence, market conditions can accommodate a sale on acceptable terms for the property to be relinquished. The exchange accommodation title holder keeps the title parked until the debt and equity from the sale can be placed in the purchased property. Funds are then balanced and title transfer completed. There are three important rules regarding relinquished and replacement properties. The three-property rule: up to 3 properties can be identified within the 45-day period as replacement. 1 to 3 identified properties may then be purchased, but whatever combination is actually used must be of equal or greater value. The 200% rule: 4 or more properties may be identified as replacement properties in the 45-day identification period. However, the total cannot exceed 200% of the relinquished property. The 95% exception: the exchanger may exceed 3 prospective replacement properties and 200% of the relinquished property. However, the exchanger must acquire 95% of what they identified. Final comments. A key concept to understand relative to the 1031 exchange is this: it's not real estate law, it's tax law. Make sure your qualified intermediary, title company, accountancy, or other is knowledgeable in 1031 exchanges. The selection of a real estate professional is vital to the exchange, not just because there are performance dates that must be met, but because the real estate is the heart of the transaction. After all, capital gains can be avoided by making no changes in the real estate holdings. Capital gain taxes are levied in the year the gains are taken. Deferring capital gains should be a part of your business plan, not the focus. The replacement property for the exchange must be identified within 45 days after the property being relinquished is sold. The replacement property must be received within 180 days or by the due date of the tax return, including extensions, whichever is earlier. If more than one property is being sold within the exchange, the first closing starts both clocks. 180 days is the maximum. An exchange started later in the year may need to have a tax extension filed to access all 180 days, but in no case can it be longer. hopefully that last video really wrapped up this package and nice and neat and put a little pretty bow on it, and you'll understand everything about it. But the first thing I want to drive home is, one, that this is not real estate law, this is tax law, and it's geared around the current tax year. Capital gains or loss recognized within a tax year. So that's where that 180-day or to the tax year comes into play, and where the 45-day timing, because they're trying to force it to make sure all of this completes within a tax year. Now, if you don't have all 180 days available to you because you started late, well, you can extend it by as much as your tax extension you file for, but you can never go over 180 days. Now, you can't take the money. Capital gains are realized when you take them. So even if you're handling it, if you mishandle this, say you think you've got a good exchange going on, you get some bad advice and you sell the first bit and you take possession of that cash and then you want to roll it into the next one, you can't do that. You can't buy the next one while the other's out because that property is transacted and finished before the exchange is done. You can't do that. So there's a lot of little subtleties in this. There are the multiple property rules in there that go with it. A lot of people will often just do a 1-for-1 because that's a big enough job to get done within the time frame. So what they might do, very simply put, is they want to maybe upgrade to a nicer property here, so they sell an older one that they've held for a while. They sell that one out. They take that equity and the debt and they put it over into the new property of equal or greater value. They don't take any money on it, and it all rolls over. But sometimes that doesn't work. Sometimes when we're identifying the future properties, we don't actually have them bought, and as a general rule, the sellers are not going to sit around with their thumb in the apple pie waiting for you for a tax benefit for you. They have their own goal, and their goal is to sell that property. So the multiple property, like the 3-property rule, when you pick it, depends on how you choose it. You may be picking it, I want up to 3 properties to put my assets in, or maybe you want one bonus property in case one of them sells out and you still have enough to where you can put all of that capital gain, that debt, in that next property on the exchange. You might want that. But with each one of those properties, it becomes more and more complicated. Which is possible for you to sell a large property and put it into 3 small properties and split it up as long as you take it all. There's a lot to this. Now, when you go into, say, a very slow economy, selling your property may be the most time-consuming thing. It may be the harder part of the equation to do. So you would do a regular exchange. You identify the property you want to buy, and hopefully it doesn't get sold before you can sell yours, and then you sell yours, move it in. Now, in a very hot market, when you're trying to sell that and your property's identified, the seller of that property can kind of use a little leverage over you because he knows you need to have that, and it has been identified as one of the properties. So they have a little bit more leverage. Now, a counter to that in a hot market is the reverse exchange, where we still have our 45 and our 180 days bound by the tax year or extension, but you also have the ability, if it's easier to sell your property than to replace it, a reverse might work for you. Because then what you do is you know that you can sell that property, and if you get stuck with a couple $100,000 of capital gains, you'll drop the price on the property that you're relinquishing just to make the exchange. But if the hardest part for you is finding the replacement, a reverse works because you do it first, you take it. Now, it's more complicated because you cannot have the title. You cannot take the title because then you take possession and it becomes completed before you relinquish. Because although you're kind of buying first and selling second, in the actual ownership trail, it still ends up being sell first, buy second, because you don't take possession of it. That's where that EAT takes his place. You have to, and it also has to be a cash money deal most of the time, because that guy selling his property doesn't give a flip whether or not your taxes are high or low. He don't care. All he wants to do is, this is my property. I've decided to sell. I want to sell it. Buy my property. Give me my money. Show me the money. I want my money. And so he doesn't care if he can sell it to you in an exchange or sell it to someone else, right? He just wants his money. He wants to be clear of it. So when you do an exchange, on a reverse exchange, you may have to pony up all of the excess money that's necessary to get that title loose from the seller, but you can't take the title because that makes it ownership. So you have to give it to a title holder, an exchange title holder who holds it and parks it, is not being the seller's and is not yet yours. You see what I'm saying? And it's 100% paid for. Now, quickly, you have to then go back and get those other properties you've identified to be relinquished. You've got to get them sold. And then once they're sold, you move that money and all in equity and the debt over to the actual exchange of the bought property and complete that out so that you get they get the title of it. It gets kind of complicated to explain, and I don't know if I did it particularly well. I did have a title man look at this and check it out. He does 1031s, and I wouldn't hesitate to give him my business doing my 1031s. But yeah, it's very similar, but in each case you're bound to a 45-day clock and a 180-day clock, which may not even be 180 days if you wait later in the year. And it's all about identification of the properties to be bought or sold in whichever direction you do it and getting it done within 45 days. And you got 180 days to get the exchange done. It's got to be in that same tax year. And say in some cases you can relinquish multiple properties to get one big property, or you can do it one big property, get multiple little properties with it, however you do it. But what you're going to get bit on, if you're going to get caught at all, is that performance deadlines 45 and 180. And making sure that the property you identify, if you were to identify a purchase property that you wanted to buy in that 45 day, you've sold your first piece of property, you've identified this other one out here, and it becomes unavailable because somebody else bought it, your exchange fails. So a lot of times people do multiple properties in it, but you got to be careful. There's restrictions in that too. Anyway, that's why it's good to work with somebody who has a little better idea than the average Joe on how 1031s work, because sometimes a forward is good, sometimes a starker is good. It just depends on how the market runs and what you have in mind. You may even decide to take a little bit of it out now. And that's something that I, as Mr. Real Estate Guy, I don't really get involved with it. That's your tax planning. But you know I'm here, and you know you can call on me and my team of friends and experts that we get with. We can get you a plan going if you want to do an exchange. If you're planning an exchange, start in advance. Let's get the preliminary work done so we know what you want to do. You may choose to do one exchange for another, or you might do some doubles. But remember, it can be real difficult, depending on marketing, to perform to get that done. And if you were counting on 3 of them and one of them fails, those other 2 better take all of that money, or you may end up paying some taxes. So how about that? I hope this helps. Remember, this is entertainment. I don't give advice. I'm just here providing you some content for entertainment. And read all those disclaimers at the end. Appreciate you watching. Have a great day.